So for those tuning into the recording, today is going to be day 23, which is actually the second to last day of the boot camp, with tomorrow being the last. Pretty crazy how fast this went. It definitely did go by faster than what I would have thought. But yeah, final stretch here, and a big focus on today and tomorrow's session is actually going to be a Q&A towards the end. So the presentation for today is going to be slightly shorter, with just kind of a few things I want to talk about in regards to trade management and what I like to do to manage my trades and what I like to do when I'm actually in the trade. So let's go ahead and get started. If you guys have any questions, leave them towards the end. Like I said, there's a big chunk of today's session specifically just for the Q&A. So the outline: entry timing versus idea quality, managing trades, letting winners work without overstaying, big kind of thing to think about. Cutting trades cleanly at invalidation, and avoiding overmanagement slash micromanagement. You guys already know probably most of the things in here, but these are some of the basics and some of the simple stuff that really built my system. And like I said, it's always the basics and the simple stuff that will keep you in the game long enough, right? Longevity doesn't come from catching big wins or looking for home run trades. Longevity actually comes from consistent actions that start from the foundations of your trading and then move from that to actually catching big wins. But in order to stay in the game long enough, right, you want to make sure that you're not blowing up, you're not taking any big drawdowns, you're actually staying consistently above water even during times of a choppier market or a market that doesn't necessarily favor your trading system. And then when the market is hot, you're actually pressing on the ideas. That all comes from your analysis, right, and how you read the markets. And then there's also kind of the psychology aspect in order to make sure that you are actually doing everything as per your system, which ties into today's session, which is trade management, right, and making sure that you're actually managing your trades successfully. So first thing is entry timing versus idea quality. You guys may have heard me talk about this already in the past, but essentially to summarize it, right, you want to be focused on not just the quality of the idea, but also the timing of the entry. So one thing I like to do is scoring the idea first. You guys may have heard me talk about this in the past. I kind of have different tiers to setups that I trade: C tier, B tier, A tier, S tier. You can kind of build up your own sort of grade book if you'd like, and use that. I think that is very, very important to have, right? And you want to have a specific checklist for each, starting from the trend, context, whether there's a catalyst, the structure, the exact setup, the lower time frames, right? And then you want to use your entries to improve risk to reward, right? Your entries should never be used to kind of rescue or to force a weak setup, which I sometimes see, right? I sometimes see a lot of traders go down to the lower time frames and try to force some sort of setup just because the lower time frames look good, but the overall kind of structure of price doesn't really favor their bias, or it doesn't favor anything at all, right? It's just kind of messy. Those are not going to be good trades. We always want the higher time frame alignment and making sure that everything is aligned and everything looks good together, right? So the lower time frame is all noise unless there is a higher time frame read that you have and you have confidence in. Planning the invalidation before you plan the entry trigger. This is also important. We want to manage risk first, right? Because when you manage your risk and keeping your drawdown minimal, that's when you can actually compound and get some massive wins. If you do the opposite instead, right, and you're just trying to get massive wins without managing your risk and you start to get a lot of drawdown, the biggest thing about that is not that you lost a good amount of money, right? I'm sure we can all kind of swallow that and move past it. The biggest issue is that the opportunity that will come in a couple of days would have been missed because now you have capital that is a lot less to trade with, right? So we want to make sure that the drawdown is minimized before we actually start to think about executing. And to do that, you want to plan the invalidation. You want to also figure out exactly how much you're risking of your account. I have a Google Sheet that I recently created that does this for me. So what it does is that it has quite a few columns: the entry, the risk on the position, and the percent of account. Those two multiplied together give me the risk on account. This is very, very important in order to make sure that you are not oversizing. Right, so let's just say on one trade, you'll figure out how much you're risking on the initial position, how much of your account is being put in, right? And then you multiply those, that'll give you the risk on your account, right? If you're risking anything that's more than 10%, then you're probably risking way more than you should. But again, this is also all preference, as I mentioned time and time again. Some traders like to be very, very aggressive. I kind of side with them. Others like to take things more conservative. It's really to each their own, right? And what people prefer depending on their goals. But the key here is to actually understand how much of your account is risking, right? And to make sure that you stick to that, right? You're not going under that. So let's just say if you plan your validation at 30% of the option price, you know that you're risking, let's just say 2 or 3% of your account. When that gets hit, you are cutting the trade with no negotiation, right? It's a non-negotiable exit, because you always have to make sure that it is non-negotiable, right? You can never kind of give it leeway, or not leeway, sorry, give it breathing room when it's time to cut. If you do that once, you're more likely going to do it twice. If you do it twice, you're more likely going to do it 3 times, so on and so forth. So the easiest thing is just to start from today, from now. Promise yourself that you're going to be very, very ruthless with your invalidations, making sure that they're planned before the entries, and making sure that you stick to them. If your timing is slightly off, right, you can either reduce size or wait. I definitely prefer to wait, but you guys also know that I like to be earlier to my trades. So sometimes I will reduce size if the timing isn't ready yet. Like if a stock is setting up for a short, for example, but it's not quite ready to break down, I'll start a position while being able to triple down or quadruple down on confirmation. All right, so I buy only a fourth, let's just say, and then I double down, and then I double down again. Right? I definitely suggest being more patient and waiting, but sometimes trades should be attempted with the smallest size and then looking for the leeway afterwards in the confirmation to add into them. The key idea is that a strong trade can survive an imperfect entry. A weak idea won't be saved by perfect timing. Right? A weak idea should always be avoided. Doesn't matter if your execution is great and your timing is great. But a strong idea can be attempted with some very, very small size on an imperfect entry, which is early. Not a fan of late entries on, let's just say, if I'm going short. I'm not a fan of going short 2 days after a breakdown or on a gap down. Same thing with if I'm going long. I don't like going long after, like, let's just say, a double gap up day and I break through a half day. Not my personal style. I like to be early, size small, and then add into confirmation. It's what has worked for me, and it is what I will continue to do. Ideally, though, we get both on time, right? The entry timing and the idea quality are both at the highest, and that's when we really press the gas. Before that or after that, right, we're maybe trying some stuff with very, very small size just to stay in tune with the market and get that feel for the market. You guys might have also heard this in the past, that the best traders in the world, right, a big part of their trading is market intuition. And market intuition can only be developed through an X amount of trades, right? You don't develop market intuition by studying the past. You develop market intuition by actually having risk on the table and actually trading day in and day out, right? Now, that doesn't mean go ahead and trade the bad setups, of course not, right? But me personally, I don't like to sit away from the markets for too long, as in, I don't like to take a week off the markets and not look at a single chart. Sometimes I might need that. But in order for me to stay in perfect tune with the market and be very, very up to date, right? I'm always checking on the markets and I always know what it's doing at all times. I mean, I can't remember the last time 3 days of trading have passed and I haven't looked at the charts. I don't think that's ever happened since I started 4 years ago. You guys don't have to be that kind of obsessed with staying up to date as I do, but personally for me, market intuition is a big part of my trading. And some parts of market intuition you just can't explain, right? Sometimes you just get a feel for price action and you can just kind of sense what's coming next. Obviously, that comes from a lot of analysis that came before that, but you still get that sort of intuition that kicks in. So managing trades once in, this is one of the biggest mistakes that a lot of traders can make. And that is over managing, right? Or it can also be called micromanaging. As in, you get into a position that looks great, right? Let's just say you're chilling, you're just watching it, and then price kind of stalls out, and you get bored, you go down, you click one, you go down to the 1 minute time frame, and you start watching price move tick by tick and letting your emotions move tick by tick. You see a slight pop, you get excited. You see a slight dip, you're like, wait, should I trim? Should I just close my position here? I don't want this to go lower. Maybe this 1 minute bar is gonna have some follow through. Okay, we're getting a pop. Yes, I'm happy. This is gonna continue to move out higher. That will end up shaking you out of a lot of the best opportunities, right? It doesn't even have to be in the 1 minute. It could be on a larger time frame. Like let's just say you're trading a contract that expires in 6 months, right? And you plan on holding, or a commons trade that you plan on holding for weeks because you think that the market is gonna go into an uptrend over the next couple of weeks coming out of a massive base. Micromanaging that could be being super focused on the hourly, right? And the hourly you might be thinking, well, the hourly is not that lower time frame, right? The hourly is important. Yes, it is. But in this specific case, right, 1 hour bar, right, that's kind of not really telling you much, shouldn't affect your trading decisions in regards to this position, right? So one thing that I do is I like to, as I mentioned, determine my stop prior and determine my take profit prior of entering. After I enter, the only thing I'm looking at is whether I'm looking to scale in, because as I mentioned, I like to start small always. In basically all of my trades, I want to say 90%, I'll always start small and then size in. So I'll get my ads in, right? And majority of my ads, I want to say 95% of my ads will come after confirmation as a position is green, right? I'll begin to scale in smaller, right? And slowly adding into my contracts. I don't add below my invalidation, and I don't double down at my stop and hope for a bounce. That is a horrible, horrible habit to have that I'm sure we've all done at least once in the past, because it's something that is very, very, that happens very often, right? Let's just say you're long and a stock pulls back for 5 hours in a row, five straight red bars into your stop loss, pushes slightly below it. You're like, you know what? You're already at full size. Let me just double down, right? I'm down 30%. Let me just double down and hope for a bounce back to break even, and I'll cut it. If you were to take that same trade 1,000 times, you're gonna blow up. That's number one. Number two, if you're in your right mind and you weren't in a loser, you would have never even attempted that trade. So always keep that in mind, right? What would I, without feeling this sort of emotion that I have that I'm down, do? Would I actually attempt this trade or would I not? That's one thing that you can ask yourself, just to kind of put it as a blocking point from actually doubling down on losers. A losing position is a loser for a reason, and a winner is a winner for a reason. Stick to that. My trims will always come into strength or target levels. I'm not really interested in trimming earlier. Sometimes you might notice that you're trimming your position earlier than the target gets hit, and that usually comes when you're oversizing. Oversizing and micromanaging have an extremely positive correlation. The more oversized you are, the more likely you will micromanage. And then you go from finding an A plus S tier setup that you have a great execution on, the timing is right, the context is right, the structure is there, and the setup is there, and you have your size in, and your entry is great, and your invalidation is great. The only mistake that you did, which you might not think is that big of a mistake, is you oversize, right? Like, let's say your full size is 10%, you end up taking 30% into that. Now what happens? Now every tick higher or lower has an effect on you because your capital is moving larger than what you're comfortable with. So now you're zooming to the lower time frames, and as you see a small 1 minute sell bar, you end up closing your position at break even or for a small win or for a small loss. You fast forward the next day, that same stock runs 5-10% in your favor, and that initial position that you took would have been up 100%. Had you just taken the size that you're comfortable with and let the position work, you would have been paid. But because you decided to oversize, thinking that you're gonna know when this market deserves that oversize, right? You're no longer in that position. That is something that has happened to me quite a lot in the past. Probably a lot more often than you guys think, especially in the days where I started to become very profitable. Because once you get that, right, and you get some sort of, you get feeling high, basically, on winnings, right? And you start feeling that excitement and thinking that you know more than the market and you are the best trader. And you begin to oversize. And right when that happens, you end up spiraling all the way back down, right? So make sure that you're not oversizing And also, guys, keep in mind, think of it this way. We know that all the best setups in the market can fail. Even if it's the most S tier chart in the best environment ever, it can still fail, right? Because the market can still have random outcomes due to catalysts, due to just price deciding to move the other way, right? Due to participants entering the market in the future. Simply put, we know that those best setups can fail. Usually, the thought process, right, or the path that your mind goes on when you decide to oversize is you see a setup, right? You think that this setup is the best setup in the market, and you decide to size in, right? Let's just say you get that first win, your account doubles to 100%, right? Now your capital has gone from 10 to 20K. Now let's just say a week later you see a setup even better than the first one. Your mind automatically thinks this setup is even better than the first one. Let me go all in again. You go all in with 20K. And the setup was literally a lot better than the first one and the best setup you've ever seen in your life. The next day, the stock gets hit with the worst news of all time and the stock goes down 10%. Your 20K opens at minus 60% and you're back where you started, and even worse. You've done nothing, right? So imagine weeks of hard work of growing that capital wiped by one bad trade. That wasn't even a bad trade. It was a good trade that wiped you out, right? Just because it decided not to work, which can happen. The best setups can fail. Always keep that in mind, right? Do not block yourself from going on that path. Have a specific position sizing tier that you follow and stick to it. I can't tell you which one will work for you. At the end of the day, it's all preference. Just make sure that you're not sizing too heavily and that one trade can't wipe you out. So in order to avoid trimming, right, to reduce stress, the reason you're stressed in the first place is because you're trading with size that you're uncomfortable with and you're not giving your stock or your trade enough breathing room, right? Because you are sized in too heavily and you are too concerned with the small ticks that are happening. Instead, take a size that you're comfortable with holding and you are comfortable with risking the invalidation that you have. So if you have an invalidation of or a risk on the position of 30%, make sure that the size of that 30% you're comfortable with. For some people, that might be, for example, a $300 loss. For others, it might be a $3,000 loss. For others, it might be 100. It's all different and it's all relative to the person that's trading it. Make sure that you're okay with that. If you are not, then you are clearly oversized. Simply put. Right? In order to let a position breathe and a setup actually work, you need to be sized correctly. And correctly, as I said, can still be aggressive. Don't think that sizing correctly means I have to only take 1%. I only have to risk 1% on my account. No, you don't. But again, it's all preference. For example, the Nvidia short that I recently took, I was risking 8% on my account. That would be considered very, very aggressive, right? If I lost in that position, I would have taken a big hit. 8% of your account is a decent hit, right? But I knew I was okay with that, right? That was part of my system. I knew that there was a time to be aggressive, right? And stick to my sizing tiers. And this tier is only used ever so rarely, right? So I'm not using this tier in every single setup that I see. Now in exits, exit fast when invalidated, no debate. Don't negotiate. Don't give it some breathing room. Just cut it. Worst case, you're going to cut it and you're going to take the loss and the price is going to reclaim and set back up again. Guess what? You can buy back. You can always buy back in. You can always open a new trade. Just because a trade gets stopped out doesn't mean the trade is over and the setup is done and that's it, right? Delete the name. No, cut it, and then if it sets back up again, just buy it again, right? It's not that big of a deal to buy something again if it sets back up again. But it is a big deal to not cut it when it's invalidated. Another thing that I like to do is taking exits, right, at the target levels and then leaving runners, right? You guys know this. I think runners are one of the most important parts of trading, even on today, right? For example, the Nvidia short that I had, it ended up running from $270 all the way up into $11.50. Throughout that, I was taking trims on the way up, right? And yesterday we reached $11.50 and that position was up 300% or whatever. By that point in time, I was down to about a fifth of my position. And with that fifth of my position, right, which has a decent size of an open P&L of 300%, I told myself I am completely okay with this last fifth going back to zero. Not red, but zero. So I decided to swing it. This was yesterday night. I decided to swing it and stay into my position and look for another sell lower on Friday, which was today. And after hours, the market was selling. I thought, okay, tomorrow I'm going to wake up and this position is going to be up 400%. I woke up today and I opened the markets. Nvidia is up 5% and then 7%. And my trade goes up from being 300% down to only 40. An immature me, what would he have done? As the position was going down, I would have started to add back in because I'm so concerned with being at the highs of my P&L curve, which is just not how trading works. You can never be consistent by thinking like that. Instead, you need to just stick to the trade and focus on the plan, right? You can't be focused on the P&L curve, right? And making sure that your equity curve is at the highest that it's been at all times. Not how trading works. That is a recipe for disaster, and that actually breeds a lot of revenge trading, which will obviously breed a lot of losses. Just a quick pointer on that. So as I mentioned, I like to always keep runners. That last 1/5 to me was risk free. I did not care if I lost that open P&L. It's either that or that last 1/5 is gonna run a 10x, and that last 1/5 is gonna make me what the first 4/5 made me. That is a risk that I said I'm willing to take, and one that I was basically paid for. Right, so I was happy with that. And on today's trade on the video, the runners didn't end up paying. Right, they went back to break even or up still 40%. But yeah. But however, on something like a DeepSeek, right, where I had no idea that was coming, that went from my last runners, my last 1/3, I think it was, running an 8x. Right, it happens time and time again where your runners are going to end up paying you more than the entire position. A great example, another example of that happened to me recently was ZOM. You guys know that I was positioned in ZOM very, very heavily early in November. I made a mistake here and I cut my runners too early. My April contracts, I had 150 calls at 30 cents. Those same contracts hit highs, I believe, of 600. That's a 44x today. My initial plan was I'm just going to put 1,000 into the 30 cents. So that means I'm going to buy like 40 contracts, I believe, something like that, 30 contracts. And I'm going to risk the premium paid and I'm going to look for a 10x. Unfortunately, I ended up taking a 3x win, which I was happy with. Fast forward, then this was 2 weeks ago. Fast forward 2 weeks later, and that would have been 44x. That's 1K to 45 or 44 grand, which is without a doubt one of the craziest contracts that I've seen. If I held on to just a third or a fourth as runners, right, those would have obviously paid because the stock never went back to my entry. It just kept on grinding higher and higher every day. So just a kind of a lesson that you guys can learn from. One thing that I really like to do is I don't just learn from my mistakes, but I also learn from mistakes of others. So other traders that I know, other books that I've read, I see what mistakes they've done and I learn from them and I kind of replicate what they did to solve them. But yeah, so that's about exits. I always like to hold the runners and then I like to trim into my target profits. I don't trim before my TPs. That is something that I stopped doing. And also, while you'll see me sometimes have big wins that are like 80 to 100%, that I sometimes let go back to break even. I'm okay with that because I want my average wins to be higher than that. So I'm holding for my full take profit, which is usually quite a bit, there's a bit of distance to reach it. So letting winners work, right, without overstaying. Let it run when price is making higher highs, higher lows if you're long. Pullbacks are shallow and get bought quickly. Your stop can trail under structure. If, let's just say, you still have a decent chunk of your account in a position that is winning, right? And let's just say you're up 100%, you're up whatever 20% of your account from that, and that's a good amount for you, right? And you're happy with that, then you don't necessarily have to let it be either a break-even position or a 10x. No, instead you can trail your stop, right? So let's just say you're long and use the 8-day as a trailing stop. That's great because as long as the 8-day holds and the trend continues, you're still getting paid. When the 8-day gets broken, right? Let's just say instead of being up a 300%, you're now up a 250%. and you take that, right? Trailing stops can be great. I don't use them that often, but sometimes, for example, Tesla, my Tesla short. I shorted Tesla 2 days ago on Wednesday, I believe. I need to double check the charts. I bought some contracts for around 450 and I caught the initial leg down. And today I was swinging also a fifth as runners and I took profit yesterday at around 300% down to a fifth. Today, when we gapped up, those contracts were expiring next week. So they didn't have that much time. And I saw my trade go from being up 300% to up only 100%, I think. I decided, you know what, I'm going to use that 100% as my trading stop. As the 100% got cut, I was like, okay, now it's down. Now I'm only up 95%. I'm going to take my win and run with it, right? So that's an example of a trading stop that worked nicely in my favor. Take action when momentum stalls at a major level and fails to reclaim. You see clear distribution or repeated rejection, or a winner becomes a different trade. All right, this is if something big hits. Sometimes you can be in a trade, right, and you're in a winner, but you see a big catalyst coming, for example, and you start to see something that you really dislike. You can definitely cut it there, even if the target isn't hit. Personally, I don't like doing that much, but sometimes if the trade has already worked, let's just say quite a bit, and you're only looking for that small bit more, like let's just say price is only 2% away from your target and you're the up 80% and you're looking for 100, but now you see some sort of catalyst hit or you see the market begin to get really hurt. All right, no one's telling you no hold and just you need that extra 2%. No, you don't, right? You start to see a price action that you really dislike, cut it. Right? The key is just that you're not micromanaging it and you're not kind of looking at it and staring at it and just thinking, please, please, please continue going up. Please, please, please continue going up. I need my target to be hit, right? That's more so a greedy way of approaching it. The rule of thumb is to trail based on structure and not your P&L. If structure stays intact, your job is to stay in. This goes about comments and about options, right? At the end of the day, the market does not care about your P&L, so why should you, right? It doesn't matter if your P&L is at the highs or the P&L is at the lows. For example, let's just say on my shorts that I took this month, I took my account up 100% on the year. Let's just say, right? Yesterday at the lows, I was up 120%. Right? Today, the market gaps up. My account is now only up 100%. So I'm down 20% from the equity highs. Am I gonna try to fight it back and get it back up to 120% and fight the market that's clearly showing signs of strength today? No, that would be very foolish of me to do. Right? Instead, I'm gonna sit in my gains, right? Sit in my 100%, right? The 20% that I had extra yesterday at the lows, I'm okay with it going back, leaving, right? Because I'm also okay with it running an extra 20% in my favor if the market decided to gap down yet another day today, right? And my run is running another 100%. Right? So don't think about the P&L curve and your equity curve. The market doesn't care about that, and neither should you. Cutting trades cleanly at invalidation. You guys all know this by now. You need to define the invalidation before entry where the thesis breaks. I'm not a fan of getting aggressive entries because when you get an aggressive entry, right, and by aggressive I mean slightly extended, your invalidation is likely going to be at a spot where the thesis does not break, but instead you can't afford to lose any more money because it's at a hard stop of 30%. So instead, I like to make sure that my entries are at areas where the thesis or the setup that I'm looking at actually doesn't validate. I'll place a stop at that, right? And I want it to also be close to where I'm executing at. If invalidation hits, I'm exiting, right? I'm not waiting for just one more candle or let me just hope for price to reclaim. No, I'm gonna set a level. If price sells below that level and I see follow through below it, I'm out, right? I'm not sitting and hoping for a bounce. Afterwards, always review, right? Why did the trade not work? Was it a bad idea or was it bad timing? Was it something that I'm missing out on? Did I not prepare for it? Was there a catalyst that I was unaware of, right? Or was it a good trade that just failed? Because that happens a lot of times. A lot of times you're going to be in the best trade and it's just going to fail because that's how markets operate. They don't operate on a very strict basis where whenever your edge is present, your edge is going to be profitable. No, that would just be an unlimited money glitch, which does not exist, right? So sometimes your edge will be present, and the setup just simply won't work. Clean losses protect your attention and your confidence, right? Your mental capital. When you take a big hit, right? When you take a loss that you shouldn't have taken, your mental capital gets hit. You can technically, right? You can afford to take a big loss usually. Let's just say you take a 40% loss. Your account isn't blown. You can survive and you can make it back over the next week or two. But the biggest issue is not the capital that is lost, it's the hit that it does on your mental, because that 140% loss is going to lead to revenge. It's going to lead to this hate that you have towards the market. It's going to lead to bad energy. It's going to lead to negativity. And the combination of those will lead to you taking bad decisions, which will then start to add up, right? From a 140% loss to now another 30%, and then another 40%. And then you're doubling down on that 40%, and then that goes 50%. And then now all of a sudden, 3 days later, instead of your account being just down 5%, you're now down 25%. And you're stuck. You're like, how am I going to make it back to where it was at 3 days ago? And the truth is, right, if you think that way, you're not going to make it back, and you're likely just going to dig yourself in a deeper hole. So cut the problem where it starts. Don't wait for it to develop, right? Cut it at the origin, which is that initial loss that you took. And that happened because you didn't stick to your invalidation. So always remember that. And always remember, you want to try to minimize your drawdown. It is okay to have drawdown sometimes. I'm not saying that's not okay. But make sure that it's minimized to an amount that you are comfortable with, right? Because keep in mind, whenever you lose, right? If you lose, I forgot the math. If you lose 90% of your account, you need like a, wait, let me pull up the sheet. So if you lose 1%, you need to make back 1%. Right? At the start, it's kind of equal. But if you lose 20, you need to make back 25. You lose 30, that's 43. You lose 40, that's 67. You lose 50, that's 100. You lose 70, that's 230%, right? Just to break even. That takes a big hit, right? And when thinking about wanting to compound slowly, you can't compound while taking these big drawdown hits, right? So always make sure that you are actually minimizing your drawdown as much as you need. Again, sometimes there will be months where you will have drawdown. Just keep them controlled and minimized, right? And you can also set some sort of hard stop on your account. Like I just say, if the account is down 5% on the month, you are forced to only trade with starter size, right? Until you start seeing some consistency again, and then you can average back up, right? Don't be that guy that is down on the account and instead of sizing down, decides to size aggressively. Bad habit. You do not want to do that. Losses will always lead to downward spirals that just keep on getting worse and worse. That is one of the most evident things in trading. If a stock or a position is showing signs of being a loser, cut it. And if it's showing signs of being a winner, then try to stay in it for as long as it's showing you signs that it's a winner. Don't exit a winner early, right? And don't hold your losers for too long. Avoiding over management, like I said, the number one thing, right? If you guys want to literally just scribble all over these, the one most important thing is don't oversize. That is, you do that, you're already cutting off a big part of it. Don't oversize. Oversizing leads to micromanagement and overmanagement. That is extremely true, and I'm sure you guys will see it in your own trading. You size bigger than what you want or what you're comfortable with. Now your heartbeat is beating a bit faster. And now you're going down to the 1 minute, and you're watching for just 1 minute sell bar to shake you out of your position. You get a 1 minute sell bar, and you shook out of an A plus great setup that ends up working 2 days later. But because you decided to be greedy, and because you decided that, no, I want to break my system, and I think I'm better than the system and better than the markets, I'm going to oversize because I know that this setup is going to work. No, not how it works. To cut that, don't oversize, stick to a sizing tier that you have built out. Have a management plan, right? As in, this is my invalidation, this is my entry, this is my scale in, this is my scale out, these are my targets, this is what I plan on leaving for runners, this is what I want to look for to hold on to my runners, this is what I want to look out for to invalidate, right? Break it all down and write it all down. Don't just break it down in your head and keep it there. That's easy for you to end up not staying disciplined to. But when you write it down, you're a lot more likely to stay disciplined to that. Limit your decisions to key levels, entry, add, trim, exit, right? With watching price behavior at all. Avoid micromanaging noise in the middle of the move. For example, a stock moves up 10% in 2 days, right? You're up 10%. Stock decides to pull back for 5 days, a pullback of 2%. The 2% pullback undercuts it slightly and ends up being a 2.5% pullback. On that 0.5% pullback, you got scared and you ended up selling your position. 5 days later, that same stock rips another 10%. Your mind was too focused on the middle of the move, right? And your mind likes to think that this move must happen from entry to target in a straight line up. This I do want to connect to us people nowadays having our dopamine receptors being destroyed and thinking that things must move very, very quickly, right? And can't have patience, right? I'm sure a lot of us struggle with our dopamine receptors just from all the media that we consume and all the scrolling. At least I'm personally speaking for myself. And that definitely does have an impact on your trading, no doubt about that, right? Because your mind is just chasing dopamine. And right as the dopamine spikes begin to slow down because you're not seeing your P&L jump and instead it's stagnant, right? Or it's pulling back slowly, you end up micromanaging and you cut it. And then you fast forward a couple of days later, you're out of a winning position. Bad habit, you want to completely block that out and just stop micromanaging. If you're checking it constantly and going down to the very low time frames, size is probably too big, right? The final takeaway, your edge will come from good ideas and disciplined execution. The goal is simple, repeatable decisions, not constant activity and not constant micromanagement. That will lead you to a bad spot where a lot of winners will leave without you, and you're going to look back at it a couple of days from now and think, damn, I had an insane look on this trade. My analysis was extremely good. This trade ended up playing out, but because I was too focused on thinking that I need to see my P&L continue to just rise in a straight line, and I couldn't afford to lose. I couldn't afford for this trade to go down from 0 to minus 10% and still be valid. I'm gonna cut it, right? Or I saw this trade go from up 90% to now up only 70%. I need to cut it because I can't see this go down to 60%. No, bad habits to have, and we want to completely remove those. That pretty much sums up the presentation. Do you guys have any questions about trade management? Does your invalidation ever change in the process of the trade? What do you mean by does my invalidation change? Like, I just say my stop was at 100, now I'm moving it from 100 to 90. No, like if price starts to look weak. Oh, so I raise my stop. Um, no. I would like to say no. Unless something actually happens in the markets. As in some sort of news scandal hits, right? We get some sort of headline, we see a ton of volume pop in, right? Then yes, maybe I would. But if price is just slightly weaker, right, and it's just kind of lower volume and it's just some consolidation, then no, I'm okay with staying in it because I was okay with initially risking the amount that I was planning on. I would only get fearful of that, right, and raise my stop higher if I was sized too heavy and I wasn't comfortable with losing the initial 30% in the first place. which never actually happens because my initial ads, when I actually am risking 30%, are always going to be small size. And then as the trade works in my favor, I'm adding into it. So my losers are I always end up being small because my size is also very small at the start. As the trade works, I begin to add to it and I raise my stop with it. But that is only after I add into the trade. So for example, if my stop was at 90 and my initial add was at 100, right? And then price moves up to 110 and I double down at 110. So now my average is 105. I'm not going to keep my risk at 90 because now I'm risking more than what I wanted. I'm going to raise my stop to 95, for example. So in that case, if I'm adding into a position, yes, I will raise my stop higher. But if I'm not, and it's just the initial position that I was planning on taking, then I will stick to the stop that I previously determined because I am comfortable with that loss. If I'm not comfortable with that loss, then I will not place that stop there in the first place and it'll be higher. But then I'm just not giving the stock enough room to breathe, right? Which is also a mistake that some traders do. There certainly is quite a few things to take in from here, but guys, time and time again, right? The biggest, the months where I have where I end up not performing the best, they don't come from my analysis being wrong, or they don't come from my analysis being not good. They all come from stuff like this, right? Your analysis can only be so good, right? And even some bad market analysts can make money because they have the basics in place, just like trade management. The thing that annoys me the most is seeing extremely horrible analysts, right? Sometimes end up printing more money than I am, right? Or just performing better than I am because they were able to stick to the basics where I got greedy and I got decided to oversmart the system. Not doing that anymore. Completely stop that. I stick to the system because I know this is what's best for me. How would you go about adding into a trade which worked unexpectedly well when you only have light size? So for example, let's just say if I start a position, right, and it automatically works in my favor, now I'm up, let's just say 50%. And now I'm thinking, what do I do? Sometimes I will add into it. For example, yeah, silver. Gold, I wasn't able to add into that one, it was too quick. Silver, I did believe to, I think if I remember correctly, I did add into it. But the thing is, you also have to just, it's preference at the end of the day in that case, right? Because yes, the trade is clearly working and it's likely going to continue winning, right? But are you adding a slightly too aggressive entry as in the price has already moved too far away from your entry and you're kind of averaging in at a very extended price? That wouldn't make the most sense. A good example of that actually is Coinbase and the trade that I had today. Let me just show you guys. But yeah, it's actually a very good question. Hold on, let me just switch over. Okay, so with Coinbase, my initial ads were, my first ad was around 150, right? So this was my first ad. My second ad was here. So this was the initial. This was the double down. So now my average entry is right around, let's just mark it out, some sort of level. I think it was around 147. The market decided to open, and right now I'm in with about 2/3 of my position, or actually no less, about half. And because it's a common trade, I was willing to size heavily into this and add. I wanted a lot more ads on this, right? So what I was simply waiting for was market to open. We get some sort of pullback, and then I get some sort of higher low to add into it near my average at around 150. I never got that. Market just decided to kind of consolidate here and then pop. So from, let's just say if I had 25 shares, and then I was looking for another 50 right here, what I decided to do is just grab another 25 right here and then leave the last 25 as kind of untouched because I don't want to ruin my average entry, right? So let's just say this took my cost basis up to here. If I added 50 up here and doubled down, right, this would take my average cost somewhere closer to here. And then if price decides to pull back, right, I would have gone stopped out because my stop is at break even. So instead, I decided to just add a third, right, rather than doubling down up here. So that's how I personally approach this trade. But again, it all depends on the context of the actual trade. Like some trades might deserve an aggressive entry up here, but generally speaking, I don't want to end up ruining my cost basis, right? Because if I had such a good entry, let's say down at 148, even though this technically is a winner, I don't want to ruin my average up to here, right? Because that would certainly change the trade, and then my stop would be a lot higher into here. Because what happens then if price decides to do this? Am I gonna let my position go red after it's being up green? I don't know. I'm not really comfortable with that. So instead, I'm just gonna leave my cost basis here. Instead of doubling down, I'll add just a third and raise my entry. My cost basis would increase with that. But it's also still dependent on each trade. Yeah, no worries. Also, guys, I don't know if you guys saw the announcement, but I am hosting a giveaway tomorrow. It's going to be two winners. The first winner will be getting a lifetime pass to a product that I'm launching in late spring, which is going to have the boot camp on steroids with just more advanced concepts, some live trading, and some weekly streams to go along with it. So it's kind of going to be my all in one spot for mentorship with live trading included and a pre-recorded course which will be similar to the bootcamp but just on steroids. So in order to join the giveaway for that lifetime pass, which is going to be worth probably around 2 grand, all you have to do is just leave a testimonial in the Discord channel. That'll be one entry. You can then copy paste that same testimonial on the wall page. That'll be your second entry. And then for a third entry, you can send me a short recording, like a 30-second video of you just explaining how the boot camp went for you. That'll be 3 entries. And then tomorrow during the stream, I will live stream me selecting the giveaway winner. So you have to get it in before then. And even if you don't really care about the giveaway, it would just mean a lot to me if you guys can leave a testimonial. Just be brutally honest with how everything went and just any feedback, what you enjoyed, so on and so forth. It would really go a long way. Okay, so in a market like recently where a lot isn't following through and chop, I think just a matter of technical analysis reads appropriate for the market. Yeah, I think it's just a matter of knowing that we are in a range, looking to route instead of looking for follow through, looking to buy dips, sell rips. You can't look to force a follow through in a market that's clearly range bound. That's gonna end up with you overstaying your welcome in some trades. Ideally, you look to take a position, right? Let's just say it's working in your favor. Price moves from support to resistance. You trim because you know that the market is in a range. And then you leave a fourth as a runner in case the market decides to break out of the range. That last fourth pays you. Fair price stalls out, and then I'll look way back and see a level I respected that didn't look like anything important. Yeah, that can also happen sometimes, right? Where buyers and sellers are just randomly battling it out throughout a range. It tends to happen. Just focus on volatility, right? Look for when it expands versus when it contracts. Don't go short at the lows and don't go long at the highs. That has been the name of the game for this market ever since October. You want to study a market similar to this? December 19th or December 18th of 2024 to February 21st of 2025. Look at what happened then. Yeah, and you gotta adapt to that, right? A big part of trading is you need to be adaptable. If you can't adapt fast enough, then you're gonna end up getting cooked. And that's only if you're being so active during all types of markets. You can also just not trade during a rangy market and then come back during a hot one. Although I personally wouldn't do that because I like to be in tune with the market. I have not been able to take bigger positions. I was able to increase the capital, but not able to increase the position size. Not comfortable at all. Hey, that's okay, right? Don't think that you are falling behind. No, you're not. You need to take it slow and slowly compound, right? So I just say if you go from buying $1,000 position, right? You don't need to jump to 1,500 next. You can jump to 1,100 next. Trade with that, and then once you feel comfortable with that, you go up to 1.2, right? Take it slow, right? Each person has their own path in trading. That's the one thing that I love about trading is that there is so much freedom, right? And we can all reach the end goals of profitability in our different ways. We don't have to follow a specific textbook. We don't have to follow a specific path. We don't have to follow a specific guidelines, right? It's about what works for you and what works for me. And at the end of the day, how well we can stick to that. Yeah, I agree with that. The markets, it's definitely the market conditions, which in my opinion, I've honestly been in love with, surprisingly. Especially this week. This has been, I believe, a record week for me by pressing on the shorts that were available. I haven't closed out Nvidia fully yet, but I do believe that that might be a record trade for me. I just need to see how much I actually made when I'm done with it. I say that as it's up 8% against me today. But yeah, that was just with the last 1/5 that I had. Thing is, I was taking $300 to $400 position, but account grew by 2K for the last month. Hey, that's a win, right? Reflect on that. That's definitely a win. And a good thing to do, right, to kind of reduce how comfortable, or sorry, to make yourself more comfortable, is to actually withdraw some of these gains. I used to be someone that I used to hate withdrawing gains, especially last year. I was mostly just focused on compounding, 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 right? My account goes 100%. I'm not withdrawing any of my gains. I'm looking to use those gains to trade. But then what ended up happening is I'd have a couple of weeks where I'd get massive wins, and then I end up getting into a capital size of my account that I am not comfortable with, and I yet continue trading with that, and then that leads to bad decision making, and I end up losing my profits. So this year, one of the goals that I had set out for myself is to actually withdraw half of my gains each week. Not even each month, but each week. So if let's just say in a month, in a week, I'm up 20% on my account. Let's just say I'm up 5 grand. I am wiring 2.5 to myself. And then the other 2.5, I'm keeping it to compound my gains. Personally, that's what I like. For you, might be to withdraw larger amounts, might be to withdraw less. It's all about finding what you're comfortable with and what works best for you. Can you go through how you compound your P&L, like how you roll your profits? Yeah. So rolling my profits is not something that I always do, because sometimes I'm very, very interested in catching the first leg in a stock, which I think is the most powerful one. And then from there, I kind of think that the stock is a bit too extended and I don't want to add into it because the trade setup is not really that valid. But other times, I actually do look for roll opportunities. And an example of that was actually MU today, where I did look for a roll. So with MU, I took a short on the opening print base and break on, what day is this? It was Wednesday. So my entry was right around 407, and I caught this initial leg lower with about 7 contracts or 5 contracts. I wasn't sized heavy on this at all. It was a light size position for me. So I ended up taking some trims and then holding some more into the next day and then also into today. And then today, what happened was we got some sort of news in the market that caused it to sell. And I was just watching it right around 10 a.m. And QQQ around 10 a.m. was showing some signs of reversal off of half day. I wasn't sure if it was going to stick or not, but I saw the relative weakness and I was like, okay, let me just try it. So if I had 7 down here, 7 from here to here, and then I ended up cutting 4, I ended up adding back 2 around here on the same contract since I was still holding them. And that brought my average down from around 407 on the commons down to like 402. And then what I did on those ads was I risked high of this. So I was risking barely nothing, right? And then I ended up cutting them for break even as they didn't work. That's one example of how I decided to roll. Another example would be on XLE. Was it XLE or was it ZOM? No, I think it was XLE, if I'm not mistaken. Actually, no, it was ZOM. One big day trade that I had on this was it was the Venezuelan news. So I caught this big move right into the Venezuelan news, and then I decided to roll some of my profits from XLE. So I decided to close some of my XLE on this big gap up, right, on the Venezuela day, for a massive win. And then I took those gains, and what I did, which was too aggressive on this and maybe something that I shouldn't have done because it was just way too aggressive, is I ended up, instead of selling any of my ZOM at the gap up, I waited for this pullback and I started adding into it all the way down to the gap fill, added some more, and then my position was essentially doubled down into here. And then as we moved back to high of day, I sold it. So I ended up essentially doubling my P&L on this with a roll opportunity. But again, not one that I would necessarily repeat because it was slightly too aggressive. I'm thinking of what else is there that I recently rolled. NVIDIA is gonna set up a roll opportunity that I'm sure of. Just not yet. Technically, this was also a roll on earnings because what I did was I caught this initial leg, right? And let's just say on this initial leg, I made let's just say for hypothetical purposes, I made 5 grand, and my usual position is, let's just say, 5 grand, my usual cost basis. Now what I'm gonna do when it sets back up again here is, instead of taking my normal position of 5 grand, I'm gonna take 7 grand, and I'm gonna risk that 2 grand, which was made, which was 2 of the 5 that was initially made here. So I'm able to roll some of these profits on this opportunity. And if I'm right, then I'm paid on that 7 grand. And if I'm wrong, then I just end up losing part of what I made on this initial leg. I don't like to think of rolls too much, because sometimes when you think about rolling profits, it ends up you forcing some trades, right? Because you think, okay, I have some profits to risk. Let me go ahead and put this, right? This is house money that I can play with. That's not the right thing that you should be thinking about. Instead, I like to just leave every trade to itself. If I caught an initial leg up or down, right? I just say if I caught the initial breakout, I don't have to roll it on the next time it pulls back if the pullback doesn't look that good, right? I like to think of the new pullback opportunity as a new trade, right? And I treat it as its own. I do that about 80% of the time. 20% of the time, I like to get aggressive with some rolls if something is really that big of an opportunity. Sorry for the long answer, but I hope I answered your question. That was great, because would have asked that next question, but I misworded the question. I know you have a system where you don't risk your capital and only your open P&L as your account growth progresses. Yeah, that is a big part of it, and that's why it's also important to get the ground rolling, especially during the start of the year. I think a big part of my success this year in 2026 will be that I had a strong start to the year, because now I can just risk those profits and be slightly more aggressive. If I had a slower start of the year, which can happen, then I would simply stay sized down until I find my consistency and then size up. You always want to size up after you see that consistency and after you have some profits to risk. You don't want to size up when you're in drawdown, right? Not because your analysis is wrong, not because you're a bad trader. All the best traders enter drawdown. The best analysts enter drawdown. The best analysis can still end up playing out against you. So the reason you're in drawdown, right? Don't try to point fingers and say your idea was horrible. Maybe sometimes, yes, but generally speaking, it's not because of that, right? So don't think that doubling down at the lows is going to fix that. Instead, you just need to get the ground rolling again, find some consistency, and then size up. Sizing up when you're in drawdown is only going to lead to a downward spiral of bad decisions. Thank you, bro. You guys have any more questions? All right, if not, I'm gonna go ahead and end the stream here. And again, please do post a testimonial. Again, forget the giveaway. It would just mean a lot to me to hear you guys' feedback. This was the first bootcamp that I ran by myself, so it would definitely mean a lot to me if you guys can leave some feedback on just how everything went, the pace, what you enjoyed the best, what you think could be improved for next time. Constructive or positive, I'm all for it. I just love to hear you guys' thoughts.